Thanks very much, everybody. Really interesting to be here in Frankfurt and being hosted by Core Estate Capital Group. So great to have everybody here. I'm just going to turn my sound off here because that'll be much easier for everybody in the live stream. Welcome to everybody who's joining us here in the room, and welcome to everybody from the live stream. We're going to be looking today at the outlook for 2022, and particularly looking at the debt and financing side. But first of all, I'd like to introduce René here to give us an official welcome from Core Estate. René.
Thank you very much, Richard. First, to do that kind of format here at Core Estate in Tower 185 in our Frankfurt office, yeah. And I mean, we all take Corona very seriously, but life has to go on. That's why I'm very happy first to welcome you physically here in our office, yeah, all the guests, yeah, and welcome you online as well for this great format. I think we have a great panel. Looking forward to see what you think about the market and everything. And that's why I would like to hand over to Martin. It's our CEO of our private debt business, HFS, in Pfeffikon. And I'd like to hand over to you, Martin. And I'm very excited to see what your views are of the market and the future. That's why thank you very much for all of you.
Yes, thank you very much, René. And also from my side, welcome to our today's European Debt, Finance and Investment briefing. And in fact, when I look here into the audience, it's a remarkable number that we have here. And this is in especially these uncertain times. It's not very usual. Okay, so I got the great pleasure to give you an introduction into the private debt business. And I will show you the development of this business throughout the last years, especially since the financial crisis. Then we will speak about the reasons why this development took place, especially when we come to things like returns and capital allocation. And at the end, I will have or give you an overview about the impact on COVID to the individual asset classes in the real estate industry, and what this maybe means for your investment strategy. We will start here. Okay, now, so what you can see here, and I think this is a very impressive chart, yeah, especially the red charts here. This shows the development of the private debt business, real estate private debt business, since the financial crisis especially, and as the entire European market is reflected into these charts. So you see here, especially since 2013, we have a number of over 20 new incepted funds on an annual basis. So that means we have here the demand for this product is obviously very high. Yeah. What you can see here, of course, is that we have in 2020, due to COVID-19, we have a certain decline. But as you can see here on the last chart, that we have in 2021 already that the market is coming back. And I'm absolutely sure that we will close 2021 with a number comparable to the years before COVID. Yeah. So what is the reason why the demand for this product is increasing in that way? So on the one hand, especially since financial crisis, we see that the traditional banks can't cover the demand for financings or for capital in general in that way as they did before. Yeah? The reason for that is the increasing regulated environment of the banks, and of course also the more and more restrictive policies in the credit approval process of the banks in Europe. Yeah? On the other hand, when you take a look at the real estate market, we see that the developments keep on a very high volume. One example, we know that until 2030, we have a demand for 1 million additional residential units in Germany, in the top 7 cities. Yeah? So you see, demand for real estate is high, and the capacities of the traditional banks are getting lower. Yeah? And for that reason, of course, we need additional financing sources. And private debt, in the meantime, established as a very good alternative investment source, and of course, is also well established in the meantime. What you can see on the blue chart, that we currently speaking about a total private debt volume in the European real estate market of nearly 80 billion euros. But what are the reasons why also from the investor side, many investors decide to follow structured private debt investment strategies? And there are a few reasons. The first thing is that we have, or private debt generates very good risk-adjusted returns. Yeah? When you see here this chart, this compares real estate equity with real estate debt. Real estate debt is red, equity is blue. And what you see here is that real estate debt shows a very low volatility throughout all years, and especially behaves quite robust also throughout uncertain times. You see this in the financial crisis around 2008, 2009, and also now throughout COVID, where we have a quite stable return level in private debt. So what is the reason for that? Of course, again, that we have stable cash flows, and we have, as mentioned before, a stability in the demand for this product, as we have high construction activities in the real estate development industry. Okay. So interesting as well here is that you see that the total return in general is in the real estate equity business, of course, is higher with 10.1% on average. And in comparison, 5.9 in real estate debt. But when you now take a look at the volatility, you see significant differences, that the volatility is significantly lower. And even when you then come to the Sharpe ratio, so you see the return per volatility, you see that commercial real estate debt is ahead of real estate equity. So one remark at that point, we here show you the chart of the US market. Why do we do this? The US market has a much longer history in private debt, and for that reason we can, we have a much longer and broader database, so that we can formulate our conclusions on a much broader basis. Yeah. Okay, next page, and I think at least as important, and at the end it shows a very similar picture, is the entire question about capital allocation. What do you see here? This is a much shorter time frame. Between 2018 until today, we see that private debt again offers a very stable capital allocation potential in comparison, for example, again, to real estate equity. Yeah. The reasons, I mentioned them already before, are that traditional banks do not cover the required capital demand. And for that reason, we have great possibilities, yeah, to find excellent opportunities to invest money, and also we have perfect access to very good assets, especially in the preferred locations. We will discuss this later a little bit, and also in the preferred asset classes. Yeah. And I really, in fact, can confirm this from our daily practice, because we currently have at HFS, we have a pipeline of around about €500 million of proven projects, yeah, where we can immediately invest into high quality assets with a share of 70% located in the top 7 cities, yeah, and also a share above 70% in residential. So we have great access currently in this market due to all the reasons I mentioned before. To invest currently our invested money. Yeah. Okay. At last, I would like to give you an overview of the impact of COVID-19 to the different asset classes in the real estate industry, and maybe what this could mean for your investment strategy. Yeah. So I think when you take a look at the left side above, yeah, it's not really something new for us. I think that especially residential assets, logistics assets, and also fast-moving consumer goods behaved rather robust throughout the entire crisis. So you see that the COVID impact was rather low and investor demand was quite high. Yeah? On the other hand, you see on the right side below, you see that especially high street, retail, shopping centers, typically everything was really hardly affected by COVID, and hotels really had a respectively lower demand of investors with respective impact on purchase prices, valuations, etc. Now it gets really interesting when we come to the office area, yeah? And here you see that somehow it's separated. And you can say the lower the associated risk with the asset is, the higher the demand of the investors is. Yeah, and the higher the risk is, the lower demand of investors is here. I think what means lower risk? Lower risk means at that point preferred locations, especially new assets, and then also quite important long-term tenancy agreements in the best case with public tenants and so on. Higher risk, of course, means short-term rental contracts. B cities is okay, but outside in the not really preferred locations, and with short-term rental agreements. So, and this is exactly what also, and I really can confirm this chart, yeah, because this is exactly what we see in our private debt funds. We have a very large share in the preferred locations in Germany, with over 70% in the top 7 cities in Germany. The remaining 30% are located to really good and really growing and with a healthy infrastructure B cities, and also with a high share in residential assets. And this means to us, of course, that or we see that throughout the crisis we were very robust with our returns. So I absolutely can confirm what we see here. Okay, this was a short introduction to the market with a few highlights, I think. And I would hand over to you, Richard, okay?
Great. Thanks very much, Martin. Now, my name's Richard Betts. I'm the publisher at Real Asset Media, and we run around 60 or 70 of these events, mainly, obviously, over the last 12 to 18 months online, but now gradually coming back to hybrid and in live as well as online. Super panel here. We'll start with introductions. Maybe just start at the end with you there, Martin. And just, although it may seem odd being in a small room that we're using microphones, that's so that everybody online can hear us correctly. So for the purposes of this discussion, the three of you will be that microphone, and Johannes and I will be this microphone, if that's okay. Great. Let's start with introductions. Martin.
So my name is Martin Braun. I'm founding partner of Nexus Capital Advisors, which is a corporate finance and transaction advisory boutique. We focus on the German market and advise on financing structures, JV structurings, but also on the asset side, typical transaction business. And started the business in 2014, and very interested in what will happen in the market. There's a lot of change coming up, I think.
Super, thanks. Oliver.
Yeah, good morning, everyone. So since it is a football day in Frankfurt, thanks for having me on this panel as a last-minute substitute player. My name is Oliver Platt. I'm a managing partner with Arcida Advisors. Arcida Advisors is a fully integrated investment and asset management platform for NPLs, and distressed real estate problems, special solutions. I am the head of transactions. I have quite a history in German distressed assets, and we share some parts of that history since I was director of legal for Hudson Advisors Germany and general counsel for Arminius Funds. Yeah, I'm also looking forward to the discussion also with the group of people in the room.
Great, thanks very much. Assem.
Hello, everybody. My name is Assem Adami. I'm heading the International Origination Division from Berlin Hyp. Berlin Hyp is probably the representative of the traditional banking sector. We're one of the leading, I dare to say, leading real estate lenders in Germany. Happy to be here, Richard.
Perfect, thanks. Johannes.
Yeah, a very warm welcome from my side to the present people here and to the audience. My name is Johannes Merklin. I'm a member of the board of Corestate, and most of you will know Corestate, which is an integrated platform providing real estate asset management, but as well management of debt funds, financings. We have 27 billion euros assets under management, more than 800 people working for us in different entities. And the company consists of subsidiaries like HFS, as you know, Corestate Bank. We have an asset manager in France, which is called STEM. And we as well run a property management business as well. So it's an integrated platform to provide real estate services on the equity and debt side.
Great, thanks very much, Johannes. So really interesting topic here, and actually a question's already come in from Rory. Thanks very much, Rory, and we'll pick that up in a second. Just a reminder to everybody that on the right-hand side of your screens, if you're joining us in the sort of RELX auditorium, you will have an area for Q&A and comment, so please do use those. I'll be picking those up, and we'll make sure that your questions and your comments are also put to the panel. So that's the joy of it being live. The question that came in from Rory, actually, and maybe let's start with that, is what's the definition of private debt here? Is it non-bank lenders and family office-led debt? So I suppose how do we see the definition for private debt?
Yeah, that's a very interesting question. With regards to myself, I would answer it that as we see or as we define private debt, it's institutional, non-bank financings that we mostly, let's say, see coming from institutional investors, insurance companies, pension funds, family offices, or high net worth individuals. Everything which is, let's say, more or less not the common way to provide financings. Probably the structures may be different, the leverage may be different. It's a kind of financing that differs mostly to what we are used to from the typical bank financing.
Okay, great. Thanks very much. So let's maybe start, Assem, since you have the microphone. Let's start with you. I suppose, how would you characterise the last? Let's start with the last year. So 12 months in terms of the real estate debt finance markets. I mean, where do you think we are now in terms of the overall market?
Well, the last 12 months, I think, have proven to be much better than we anticipated, and I think many. Berlin Hyp, as well as many of our competitors, will say that it came very near to a very normal non-COVID year. We had very little effects on our portfolio, but that we lend in very few transactions against hotels. We don't have a lot of shopping center exposure. So those are maybe the two asset classes which have been the most affected that we've seen. And generally speaking, for Berlin Hyp, it's been really a good year, I dare to say, and it has been very strange. Yeah.
Okay, good. And let's pick up. I mean, Martin, from your point of view, I suppose pick up that point where you see us now, and also where you see us heading in terms of 2022.
Well, I think investor demand, and also as far as finance is concerned for the typical core product has been very strong through COVID. what is a bit different is for a product that is not absolutely core. And what we experience is that, especially the traditional lenders in Germany, if a product does not tick all the boxes, they tend not to finance it at all. And so that is something which I believe we'll also see over the next couple of years, that the financing environment for that type of product will get more complicated. And then, of course, also alternative lenders that are not the traditional providers of real estate debt may play a more important role.
Okay, good. And Oliver, maybe picking up from your point, because I know you're looking also at the sort of NPL side of things. Where do you see us at the moment in the market?
Yeah, well, NPL, I mean, as an NPL veteran, I'm really looking for a comeback for almost 15 years. And I think we can all agree that the German banking market is rather robust. So we're not talking about 1.4 trillion expected NPLs like we do in the Eurozone, but more rather about what the Federal Association of Servicing and Credit Purchasing just released a couple of days in their autumn snapshot, like 40 billion in 22. So we don't see like those big portfolios like back in the day with Hypo Real Estate, but we see rather single assets, single transactions, where the banks are under a certain pressure and are somehow hinged between the real economy, like Martin B., the first Martin B. showed us earlier, COVID-19 as a catalyst, bringing potential tenants under pressure. Then we see probably covenant breaches in our loan agreements. And on the other side, we have regulatory impact. We just saw the Sixth Amendment of MA-Risk, which says as soon as we reach a 5% threshold in our internal loan book of NPLs, we have to find some strategy to either manage them or get rid of them. And this is something we don't expect a big wave of NPLs, but we expect a cleaning up of bank books, and we need some players in the market who can deal with that in a discreet and trustworthy way, so that guys like you can sell it off without being on the German tabloid bill the very next day, so that you guys can concentrate on lending in more like robust real estate, and the private debt guys can lend on more like riskier asset classes.
And that's obviously you as a representative of the banking industry as a whole, not yourself there, Asam. So.
Obviously, yes.
Good. It would be interesting, I think. I mean, we saw Johannes in Martin's presentation earlier, but obviously you could see in the figures the growth in that private debt market. I suppose what's driving that, Johannes, from your point of view? And I guess, is that sustainable long term, or is this a sort of short-term growth phase?
Well, if we compare the private debt market in Germany or in Europe compared to, let's say, other regions like US, there's still roughly 80% of the financing being done by typical banks and the all well-known instruments, whereas 20% is financed through private debt kind of instruments and funds. In US, it's the opposite, right? The overall number of financing is done in, let's say, other means, much more volume in private debt. So answering your question in this respect, I think there is a lot of potential here in Germany, but in Europe as well. And we see that. What is driving this market actually? On the one side, there's still a low interest rate environment that we have, where institutional investors need to find respective assets, secure assets, stable assets with a lower, let's say, risk profile, which will be in any kind of, we talk about financings, real estate financings in LTVs up to, let's say, 70, 75%, or even higher risk on the mezzanine front. So from a demand perspective, there is respective, let's say, need for more of these kind of assets, but as well as we see other players in the market, just like developers or people that are purchasing real estate, yielding asset portfolio transactions. These kind of real estate players need quick financing, they need reliability, and what we discussed beforehand, that currently, but we would see it ongoing with regards to regulatory constraints, banks will probably more and more only take part of this volume. Hence, from a demand perspective for financings, there will be a much more and a higher increase going forward for other sources of funds, which will come and are coming, as we see from the institutional side.
That's interesting. Thank you. Maybe just coming to you. Did you have a question there?
Actually a question,
Okay.
If
It's allowed.
Speak up.
Yeah.
Maybe, actually, thank you very much for the presentation. I think it's very interesting. I have just one question. If you would make the distinction between income producing and development, right? Because there's a risk difference, right? What is the perspective? Well, what is more interesting? What will we see? Well, what will we see in NPLs? What is the focus here of Corestate, and what makes sense?
Well, if we talk about the market and where we concentrate on, we're concentrating on respective residential kind of developments, everything which has is supported by, let's say, a lack of supply, which is the residential areas. Martin Bassermann in his presentation mentioned that there is a number of actually 1 million, but the number is on an annual growth rate. We need more than 400,000 residential units built in Germany per year. That's why we focus and are financing mostly on these kind of, let's say, residential developments. We are currently not focusing on hotels or, let's say, respective developments which have a higher risk. So we will support and finance and structure financings which are based on an underlying need. And of course, yielding assets, I mentioned it briefly, we see more and more demand for private debt on yielding assets, just simply because people or players, they need reliability and they need quick kind of financings, which banks at the moment, to some extent, can't deploy. So what we see here is a more kind of bridge financings with a shorter term until market participants get their respective financing from the banks at a later stage.
Great, thanks. Thank you, Libor, for that as well. Just coming to you, SM, I suppose interesting that there was the point there earlier from Johannes about interest rates, but also if you want to pick up the point from Oliver about whether after 15 years this is going to be his year, 2022. What's your view? But obviously there's been the discussion around 22 onwards, yeah, that there's been a lot of discussion around interest rates, and that's been changing over the course of the last 12 months. So I suppose, plainly you don't have a crystal ball either. But what's your sense of that and either the potential risks there in terms of you as a lender?
Yeah, first of all, we're picking up on what has been said before. Obviously, the stable situation which balance sheet lenders are in today is also supported by the low interest rate environment. And if we say low interest rate environment, it's not going to make a difference if the interest rates go up by 20 or 30 base points. But if they go up significantly, then there will be a change. Now, as you rightly say, the the play between inflation rate and interest rate has gotten extremely complex, and it's extremely difficult to foresee anything. We still think that we're going to remain in a low interest rate environment, and I personally think that looking at public deficits in the Eurozone, there's hardly some room for significant change in the interest rate environment. So, but having said this, there is going to be some volatility maybe, but we think there is a lot of headroom for the banks, a lot of headrooms in the cash flows in most of the asset types. There's, as we said before, there are some asset types which are under stress, of course, but I don't think that, I'm sorry, Oliver, that there is going to be a big wave of cleaning up, of necessary cleaning up.
I can see a queue now waiting to discuss this.
But Joachim Würmling of German Bundesbank wrote an article in September, and he wrote, "There is no vaccination against distressed loans." So what he said is, the bank should be very careful to release their risk positioning, their Risikovorsorge. And of course, as I said before, German banks are very robust. But there will be like single opportunities. That's what I'm saying. It's not that someone is underwater, so to say.
Yeah, absolutely.
Martin, you wanted to pick up on that as well.
Probably to add to it, so I think the German banks have been very disciplined, but there may be situations where they simply want to get rid of loans because they don't have a capacity to deal with it. And that's one point. And where I believe probably more potential for you will be is the area of developments where you had some, let's say, subordinate debt providers who have provided debt without having the necessary risk management and monitoring tools and procedures in place. And I believe if the market environment changes, probably construction costs go up significantly, rental growth slows down, that some of these developments may run into problems, and there I would see much more potential for some kind of distressed opportunities.
And probably adding to that, I was speaking at Expo with a guy from a regional Volksbank, and he was already scared that he might put down an equity deposit for NPL situations of 150% equity. So this is something everyone is like a bit freaked out and tries to solve that problem before the actual loan becomes a NPL, working out the distressed asset with the borrower and then finding solutions. Now I have an echo.
Good. And it might be interesting just, Asim, from your point of view, obviously there's, in terms of the trends, I guess, that we're looking for 2022 going forward. I mean, we were doing a session yesterday focused on CEE where the presentation had ESG at the top of each of the sections, essentially, as the key trend. And obviously that's also going to be something that's going to be influencing the financing side. So I suppose, how do you see that working, and how will that be influencing what you're doing as a bank?
Well, I think real estate as a whole, if we take the institutional part of the real estate industry, ESG is on top of our agendas everywhere, be lenders or investors, developers, anywhere you look, ESG is on top. And why is that? Because also it's going to be, the times have revolved where ESG was sort of a idealistic feature. It is part of our business now. It's part of our capex plans. It's part of our projections of equity exposure when it comes to the balance sheet lenders. It's part of our business now, and we will have to take a view on that. And that means that institutional lenders, as investors, likewise, will concentrate on the core part of the market, or I'm sort of hesitating to use the word core, but the ESG part of the market. Those assets which are capable of being transformed, although those are which are already ESG or even better taxonomy compliant. That's the chunk of the market that institutions like ours, of course, will take a very close look at.
And does that mean there's going to be a situation where there'll be a number of assets that therefore, I mean, obviously if the banks are therefore stepping away from some of those assets, that there will be a number of assets that are either stranded or seeking alternative forms of financing?
Yeah, well, if the property is not already ESG or taxonomy compliant, then you have to have a plan how to transform it. And of course, it's one thing in an environment where you have rental levels of, I don't know, 30 or 40 euros a square meters. That's relatively easy to make it work to turn that into a green building. But if you are in a market where the rental level is more like 12, 15 euros, that's going to be a challenge for one or the other asset. However, I think that on the innovation side and on the technology side, we will see that there will be some solutions offered so that the apocalyptic vision of huge amounts of stranded assets will probably not materialize in that way. There will be some amount of stranded assets, but not. I don't expect it to be that huge as we might foresee it today.
Okay, good. I'm going to come to you in a second, Martin, just on that. But Johannes, is that potentially then, I suppose, more of an opportunity for the private debt side to move into some of those areas if the banks are stepping away from that? And I mean, we saw from the chart that there's a huge growth in terms of the number of new players coming into the market. Is that, does that mean that we're going to see a whole huge rash of new kind of people coming into the market, or are there limits to that? What's your sense of it?
Well, let me firstly say private debt is not a substitution for bank financing, right? So it's a complementary, let's say, instrument that actually takes part of the market where banks are not active. And again, what is driving this? It's on the one side, it's probably what we see. It may be the leverage. It may be the speed. It may be the respective on the development space, the respective situation on the property. For example, building permission is not granted within the next, let's say, 1 or 2 years. So banks just simply don't participate in financing in this respect, or not in the needed volume. So there is a very big opportunity here where just banks simply don't participate, and the need for financing is going beyond what's been provided by banks. So again, it's a complementary instrument, and what is, let's say, in terms of players, we see institutional investors stepping specifically in the next year, in 2022. What we hear from discussions from the institutional side, they will even start and discuss to deploy more money on the private debt side, specifically for real estate financings. The same is if we talk about domestic players, definitely, but as well from abroad. If investors, let's say, be it from Asia, be it from North America, if they want to participate in the private debt market in Europe, they will focus on Germany. And that's why we had a couple of Asian investors in front of us earlier this week that are telling us that they're going to step out of US on the mezzanine side, but now are focusing significantly in Europe with a strong focus on Germany. So there is more and more demand coming domestically, but even from abroad. And there's one, let's say, market participants that we did not speak about yet. It's the retail, and that's what we see, for instance, on all the digital platforms that are currently growing and growing on these kind of financings. We need to be very careful about the credit quality, about the underlying assets, but there is another big source of demand to actually participate in financings. Corestate is going to prepare for that as well. But generally, we don't see any shrinking in this market. It's the opposite. The market of private debt will increase.
Great, thanks. Essen, you wanted to pick that up.
Yeah, maybe just to underpin what you've just said. If we take the numbers, 80 billion of private debt market, my guess would be, correct me if I'm wrong, 20 billion would be in the UK, probably, something like that. So leave us on continental Europe with 60 billion, which is the equivalent of 2 loan books of a bank like ours. So just to put it into perspective, so there's room for growth in that field.
Okay, great. Libor, yes.
Yes, Richard. Yeah, sorry to interrupt you. Just very interesting. JLL just published like a number which is very interesting. 12 German banks have published a new business, and it's actually up 6%. Right, so its senior lending is up 60%. Does this mean like that transaction volumes will be increasing and are increasing? It's like,
fantastic to get live news
like
coming on.
Information advantage.
Yeah, exactly. Yeah. Does anybody want to pick? I mean, I suppose, you know, if we're seeing that kind of growth, is that going to continue? What's everybody's sense of that? Martin, it'd be interesting to get your view on that, but also your kind of take on the stranded assets side as well.
Well, to answer your question first, well, transaction volumes are very high. Whether we'll see a record this year, I don't know. But there is very strong demand for real estate investments in Germany from domestic and non-domestic investors. It's focusing to a large extent on core assets and the assets that have not be negatively affected by the COVID crisis. So, hotel investments is not the flavor of the month, obviously. And I expect that to continue, also given that real estate is a good inflation hedge, and with the inflation scenarios that we are currently seeing, it will be even more interesting for institutional investors to have a larger exposure. As far as the stranded assets are concerned, so I fully agree with you. There will be technical solutions to improve existing assets, but we have to be aware of 2 points. One is, obviously, it makes much more sense to use existing buildings and to reposition them rather than tearing them down and doing a new development from a climate perspective. That is one point. So there will be players specializing on converting outdated buildings into something that is more or less ESG compliant. But we are talking about a pretty large portion of the market. So I would say it's 75 to 85%, and that means there's a lot that will have to be done over the next couple of years, and therefore there will be stranded assets, and there will be also a lot of players taking care of them.
And is that a potential in terms of the non-performing loan side, Oliver, or if you like, for funds that are looking at broken core and those kinds of things?
Yeah, absolutely. I mean, we hear that question a lot. How do NPL business and ESG go together, right? So because obviously everyone knows NPL from back in the day, the Lone Star funds, the Cerberus, just trying to get the 2 times multiple returns. And what we did back in the day, and we got the whip from Dallas, foreclose immediately and then try to max out on foreclosing sales. But there was a learning curve. So we learned it's the best way to have a mutual relationship with the debtor, to find a solution with the debtor, because that's more effective than go through a 3 years, 2 years foreclosure procedure. And ESG, I guess, is an absolute fit for NPL business, because what NPL means, if you have an NPL investor, he brings fresh money into those situations where a property owner, a debtor, is underwater, and so you can turn a distressed property into probably a CRE building. So on the E side, on the S side, you can help the borrower get back on its feet. You can work with local contractors, craftsmen, local banks, regional banks, and also you can help the communities to fulfill their urban development plans. So I guess ESG and NPL in the new world, they fit very well together, but everyone only knows the past, so it's like a contradiction for a lot of people, but we believe it is actually not.
And Assem, how does that, I mean, Oliver there mentioned the sort of repositioning. How does that fit into your kind of transformation loans, which I think are just for Germany at the moment, and are there plans to extend that beyond Germany?
Yeah, well, first of all, as you probably know, Berlin Hyp has a quite significant green agenda. We try to have a third of our loan book be green by 2025. We strive for full transparency in terms of CO2 emissions on our portfolio, et cetera, et cetera. And in doing that, we've been the first ones to issue a green fund brief. So on the capital market side, we're still the biggest private issuer of green bonds in many asset classes in Europe. On the lending side, we're introducing the green loan, which is useful for those of our borrowers who have a ESG reporting. And we also are developing a transformation facility, which is, to be clear, which will be a subsidized facility for the transformation of brown to green assets. Having said this, to answer your questions, of course, in an ideal world, we'll offer that kind of offer to any borrower that we'll encounter, so maybe in Germany or elsewhere.
Okay, great. It would be interesting also to just pick up on the sectors, because there's around kind of 15 minutes left. So I'd be interested to pick up on, particularly for 2022, where we see lending in terms of the sectors. Has this changed due to COVID? We saw from Martin's presentation earlier, the more negatively affected ones, such as retail, such as leisure and hotels, potentially. So maybe let's start with the private debt side, Johannes. What are you seeing in terms of, I suppose, the desire to lend on specific, either geographies or sectors?
So what we see from a geographical point of view, there is still, let's say, Germany, the domestic market, and that's where we mainly are focusing on. That's where there is still a lot of activity in 2022. But as well, we see selective, let's say, growing activity in Southern Europe, be it Spain or Portugal, and obviously in the DACH region. But again, I mean, Germany being the biggest, let's say, real estate market in Europe, most of the activity will take place here, yeah.
Okay, good. And for you, Assem, I mean, obviously we've seen things like logistics yields heading further down. Things like that. So although that may be the kind of flavour of the month, does it make it more difficult in terms of loans? What's your sense of whether, are there things that you are willing to lend on and things that you are now not willing to lend on? I suppose, what have you seen as the changes, particularly looking at the sector side?
Yeah, well, we haven't blacklisted any asset class, to be honest. There's some other asset classes that we haven't touched before COVID and will not touch today. We don't have for example, we don't have the expertise to finance data centers. To be honest, we've been very hesitant before to finance hospitality assets. So. Nothing really changed. Of course, when it comes to retail, we're a bit more conservative. But having said all this, all asset classes are in some sort of in a change process. So we live in very interesting times really today. And it's very interesting to see where we're heading in any asset class. So we try to foresee where is residential going. We try to foresee where's logistics heading. To be honest, some yields in logistics are difficult to comprehend, but generally speaking, of course, logistics is a very attractive asset class, and so is office. And by the way, office, we strongly believe in the office asset class, and we strongly believe that our working place is not at home in the kitchen or in somewhere in a corner of your living room, but in the office. So the home office, all this home office discussion, this is going to be an offer which is interesting for employees to be more flexible, but the main working place, and I think you agree, and with Core Estate, the main office, the main working place is the office.
Okay, Martin, is that what you're seeing also from your side, I suppose, from clients? Is there a sort of uncertainty about some of the sectors, particularly because that discussion around office has also changed quite a lot over the last 12 months?
Yeah, well, of course, there's uncertainty as far as office is concerned, and there are very different views. Well, I tend to agree with you guys that, well, offices won't disappear. It's simply not an option. That everybody will be working from home is simply not possible because people don't have the infrastructure and the space at home to make that work forever. So that. But I think there is probably from a lending perspective not a major shift as far as sectors are concerned, but if you call it that way, a flight to quality. So what we are seeing is that banks only tend to finance investments that tick all the boxes, and that's at least what we see, that just over the last 2 or 3 years have become much more selective. And I think that will continue across all asset classes, whether it's logistics, offices. Of course, when you look at retail, to get a financing for a shopping center that doesn't have a food anchor is, I would say, almost impossible if it's not at a really bargain price. And so that's what we believe will also be the theme for 2022.
Yeah, that's interesting. We had a discussion actually yesterday with Kaufland on the panel there as well, which was talking about their strategy of growth, because they're suddenly seeing opportunities as a generator of footfall to be able to go into shopping centres, to be able to go into high streets, to be able to, grow. I mean, they were specifically talking about their strategy for CEE, but I know that that's also similar for Germany, that they're actively then looking to step in to the real estate parts where they've never been before, because they've always been in hypermarkets before. So that's interesting, that point, Martin, because that picks up on that. There's around 5 minutes to go, so if you've got questions, now is the time to put them in. So please do that, and I'll try to reach those if I can. It would be interesting you mentioned a little bit around the kind of loan side there, Johannes, but it would be interesting so let's say, for example, there is an investor who is looking to invest, say, 200 million or something like that. Where does Core Estate step in at that point? What part of the loan? How does that actually work?
Well, if we define an investor as, let's say, a real estate developer, for example, or someone that wants to purchase a real estate property, be it a development or a yielding asset, Corestate would, let's say, simply analyze the capital structure, which would consist typically of a larger senior secured loan or note, then some part of mezzanine, and obviously some part of cash equity. And so what we then would either do is, if there are any possibilities to lend through our subsidiary HFS in the form of mezzanine capital or out of our senior strategies, we will deploy respective funds out of that. Or it may be a combination between direct asset financing via Corestate Bank, a combination of institutional investors and HFS, or if HFS may not fit, there might be another debt fund. So what we actually provide is an analysis of the capital structure, and we will just take the dots together to provide a financing in the respective timely manner and in the respective leverage.
And you mentioned that would be, that's often a complementary thing with banks such as, ASEM there and Berlin Hyp. So I guess, do you then, how does that partnership work?
But as well, I mean, let's be very open. We are providing, let's say, bank financing as well, in terms that we will have a discussion with banks whether they take part of the capital structure. So that's why I say it's not something which is a substitution of bank financing. It's a complementary, let's say, skill set of different private debt instruments that we provide for our clients. And let me allow one thing to mention. If then such financing happened, and let's talk about a development as a potential, what Corestate then would, let's say, do over time, that we take this financing, which then, and this asset, which at the end will be developed and it will be built. And then we have a direct, let's say, access to the developer, to this asset, and we will ask and take this opportunity to even convert it into one, let's say, of our potential equity strategies. I think that's what I said before. On the financing side, we will structure the capital structure. We will provide the respective instrument, be it a combination of bank and debt financings with our fund strategies. And at the end, after 2-3 years' time, we will convert it into our real estate equity strategies.
Okay, good. Question that came in earlier, actually, from Leah. And so, Leah, thanks very much for that. And I promised to come through it, and I am. Which is, actually, Leah was asking about it from the private lender's perspective, but let's take it from the whole of the lending perspective, which is, have requirements changed since COVID hit in terms of deal types or covenants? So it'd be interesting just to pick up whether or not covenants have changed, and also it'd be interesting to know whether or not there's differences, dramatic differences in terms of pricing between, say, of deals, say, between UK, between Germany, between France. So for anybody operating in those areas, that would be interesting to pick up. Does anybody want to take that? ASEM?
Sure. Maybe to start with the international view. We were active in the Benelux, France, Germany, and Poland and Czech Republic. And of all these countries, my sense is that Germany and France are the most competitive markets, and margins are the lowest, and it's sometimes quite difficult to get the mandate and not to be the cheapest one. That's not our goal. When it comes to regulatory, let's say, additions, more modifications due to COVID, the banking authorities have, of course, asked us to stress our portfolios and to take a very close look at the risks, in particular when it comes to hospitality and retail. This has not resulted in significant changes of our business case, but it has, of course, made it a bit more complicated. I wouldn't say difficult, but a bit more complicated to finance those two asset classes.
Okay, good. Martin, did you want to pick that up in terms of the pricing side as well?
Well, I think through COVID there was no significant impact on pricing. As I said before, there is some kind of flight to quality. But it's not a big pricing issue. And if you have the right asset in Germany, you'll get that financing. And if you compare it to the UK, in Germany it's also much cheaper. And so therefore, if you have a good real estate deal, Germany is still a very, very comfortable place to be in.
Okay, good. We're pretty much out of time now, so let's just pick up on a kind of last question, looking towards 2022, I suppose, and beyond. So, what are the biggest trends and opportunities that you see for debt finance and investment markets in 2022? And you've got about 30 seconds each on that. I'll allow you a minute. Let's start with you, Johannes. Just, I suppose, so what are you seeing as the key trends and opportunities there?
Well, as we said, the key trend is the market will grow. We will see, let's say, more inflows from let's say, domestic, but as well money outside Germany, from Asia or from North America. In terms of participants that are providing and deploying private debt funds, we will see increasing deploy of funds from the institutional side, but as well, as I mentioned, trends like retail, high net worth individuals. That's some of the key trends and topics that we'll see and where we will be prepared.
Great, thank you, Asim.
Well, our strategy will not change significantly, but I think you've mentioned it before. We will seek quality, sustainability not only in the sense of ESG, but also sustainable demand for the property, sustainable cash flows. That's going to be key. So, and that in whatever asset class we will be talking about.
Yes, from an NPL investor's point of view, so I'm speaking to financial institutions almost every day. I believe, and it's really a belief right now, that the German banks will watch their default-prone SPL situations, and before reaching their internal 5% NPL threshold or having to provide an equity deposit, they will find a solution to manage such a distressed situation or to sell it off. So this will happen. So then the traditional banks can focus on financing the more safer real estate classes, and the private debt guys like you can focusing on financing more riskier classes with probably a higher margin, high equity ratio. That would be my outlook.
Well, I think from a borrower's perspective, it will be key going forward to find the right structure and the right partners, because the overall environment is getting more and more diverse, and that will be the key challenge. There is not the right financing partner for everything. You need to be selective and creative to find the right structure and identify the right partners.
Great, thank you very much. Really interesting. Thank you for all of your questions and comments on the chat. That's been great to see. Thank you for your questions in the room as well. Really interesting discussion. The next sessions that we've got coming up are one focused on infrastructure, so crossing over between real assets and real estate, looking particularly at the transportation side and how that blends into the logistics real estate side. That's on December the 2nd. We've got UK senior living markets on December the 7th. That's a new market report that's coming out on that. So if you're interested in that market, do feel free to join us. And the last one of the year is going to be focused on France and an outlook for 2022 on December the 9th. So do feel free to sign up and join us for any of those. Thanks very much, Renee and Martin, for the presentation and also for hosting us here in Core Estate's office. Thank you, panel. Really interesting discussion. Lots of points to pick up on there, and we'll certainly look forward to seeing how some of the predictions work out in 2022, which will be interesting. And if you could join me in thanking both yourselves for joining us here and the panel, that would be great. Thank you very much. Thanks.